Well, it was a pretty wild week for financial markets last week as President Trump followed through on his latest tariff threats. And we had a dismal July jobs report as well, which of course saw the president ramp up his attacks not only on the Fed, but also on the Bureau of Labor Statistics. And of course, markets striking a relatively defensive tone amid all of that. Stocks notching their first weekly loss in three. Treasuries rallying hard, led by the front end of the curve, and the dollar rolling over as well. The new trading week getting underway on a somewhat calmer footing, but a few notable catalysts to watch in the days ahead, including tomorrow's ISM services survey and likely a 25 basis point cut from the Bank of England later in the week as well. Nevertheless, plenty for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So a very busy week for markets last week. Joining me to try and make sense of everything that's been going on back from an incredibly poorly timed holiday is my good friend Ryan Littlestone from Forex Slow Live and Forex Analytics. And Ryan, I've got to warn you up front, if you say or do anything on this show that I don't like, I will send out a tweet firing you immediately and replacing you with a yes man who puts loyalty to me above everything else. Because if that's how the leader of the free world works, that's how the leader of the trade-off is going to work as well.
In that case, I resign. Like
Right, off you go. I'll do the rest of it on my own.
Yeah, go on. I'm going to sit back now. You can do the whole show on your own.
Well, in that case, topical thunder. We can just edit you out. I'm sure Kyriakos can. We had a Muppet here last week. We can have a Muppet there this week.
I've still got a Muppet here. But anyway, carry on.
Less than that. Right. Oh, blimey, I could do with shutting that noise up. That horrible noise that you heard there was an alert that I've now set up for when President Trump posts on Truth Social. So I'll stop that going off before we get any further
like
into the show.
Siren.
Well, absolutely. It's like an air raid siren in here most of the time. Anyway, where was I? The jobs report, payrolls numbers that we had out on Friday, to get back on some sort of topic. It was a dismal report, to be completely honest with you. It was not rigged, as President Trump has just said it was, but it was a pretty grim set of data, to be completely honest with you. And it is tough to find any positives in that slate. If we just take the numbers step by step, headline non-farm payrolls, they rose by 73,000 in the month of July, considerably below the 105,000 consensus. But what was more worrying than that was the net revision to the prior 2 months worth of data, to the May and the June figures. That was a huge 258,000 to the downside, which leaves the 3-month average of payrolls growth at a pretty paltry 35,000. And really, for all intents and purposes, we're basically sat here saying the US economy has added no jobs over the last 3 months. The other reason why that net revision is important is because we've all seen slightly dodgy headline non-farm payrolls prints come in before, and they're relatively easy to explain away as a one-off. Well, the problem is when you've actually got that big downward revision to the prior 2 months as well, it's much harder to shrug this off as a one-off, and it sort of indicates that this could be a much weaker US labour market than we had previously expected. Earnings pressure is still contained, rising 0.3% a month, 3.9% on the year. But then there's more bad news when you look at the household survey. Labour force participation down to 62.2%, which is a cycle low, likely dragged lower again by this ramping up of immigration enforcement. And that is keeping a lid on the unemployment rate. Unemployment ticked up to just 4.2% from a prior 4.1%. The reason unemployment hasn't risen more is because the size of the labour force is actually shrinking. If participation was back at the cycle highs, then unemployment would probably be well north of 4.5%. So I think that U3 rate risks sort of lulling people into a little bit of a false sense of security. So a very grim report. The market response to that was pretty much as you would expect. Stocks dumping, treasuries rallying hard, the dollar sliding, and at one point the market pricing a 90% chance of a rate cut from the Fed in September, and the usual hyperbolic nonsense on business TV with people even talking about intermeeting rate cuts, which are frankly not going to happen. That was the market's response, which was relatively predictable. President Trump's response was in part predictable, the bit where he decided again to bash the Federal Reserve and moan about Fed Chair Chair Jerome Powell. The bit that wasn't quite as predictable was the firing of the BLS's Commissioner of Labour Statistics, the lady who was in charge of putting the jobs data together. Apparently, because the jobs data was so bad, that means that it was rigged against him. Proper sort of Erdoganomics, Banana Republic type stuff going on with that one. Where does this all leave us? Are the Fed going to panic, I think, is the big question. And it seems no, and nor should they, to be completely honest with you. We have a long way to go until the next FOMC meeting in mid-September. And we do, of course, have the August jobs report due before that meeting as well. In addition to that, and as both Hammack and Bostic said in their interviews after the jobs numbers on Friday, the inflation side of the mandate is further away from its objective than the labour market side of things at this moment in time. So given the data we have at the moment, a wait and see approach still feels appropriate. But on the subject of the Fed, a little bit of a curveball coming late on Friday, and that was Governor Kugler, who had missed the July FOMC meeting for personal reasons, announcing effectively her immediate resignation as governor. Now, of course, that gives President Trump the opportunity to fill a spot on the Fed board, and whoever he puts in that spot, you would imagine, is someone who he would want to step up and be Fed chair next May, because the next board spot that expires after Kugler is Jay Powell in 2028, and there's every chance that he may want to stay on as a governor once his term as chair expires. So if Trump wants to pick his Fed chair, this is probably the pick that he's going to have to use to do it. Now, there are a few names in the fray that I'm sure we can discuss maybe in another episode, but number one at the top of the list in terms of characteristics on that job description is going to be undying loyalty to the president, and number two is that you'll vote for a rate cut at every single opportunity. So I would imagine, sadly, that probably rules both you and me out of the running for that one, Ryan.
I'll tell you what, they couldn't pay me enough to go and do that job. Neither at the BLS, and I heard the head of the ONS, who got booted out the other month, is applying for the BLS role. So they're looking to improve things over there. What a Friday, particularly coming after that FOMC where they kept rates on hold and the market was like, okay, we everything is normal, and then to get that NFP number dropping out the hat. Where do you start with that? Typically, next month we could get a 250k NFP, and everyone would go, well, what happened there? That was just a bit of a blip. I'm not sure if we've got to the bottom of why the revisions were such as they were. I read the note on the BLS report saying that it was seasonal revisions and recalibrations and all that sort of palaver, but no real reason why those numbers are skewed so violently, if you like, which is a bit strange for this report. I mean, I know we're used to the year-end revisions that we get sort of January of the prior year, and they can be a bit hefty, but this was just a shambles, and it doesn't bode well for the US and confidence in the US, which has been suffering of late under Trump, and I think that lack of confidence is going to continue for a while longer.
Yeah, I think that's the big takeaway. And you sort of asked, where does this leave us? Because, Trump is obviously going to appoint someone, we don't know who, but someone to this role at the BLS. Do we now have to question the data that comes out? If we get, for example, as you say, a 250, 300, 350,000 NFP print in August, is it legit? Can we trust it? Can we rely on the data that we previously thought was the sort of gold standard of economic statistics? Is it now, going to be sort of politically skewed? There's also questions over whether, of course, policymakers can rely on it, whether they be fiscal or monetary policymakers. There's also this general, as you said, erosion of confidence in economic institutions that are independent and arm's length from the government for a reason, whether it be the BLS, whether it be the Fed, whether it be any of these other sort of institutions where, the president is effectively trying to bully them into doing what he wants them to do. And I think, looking at where markets currently trade, I would argue that there's nowhere near enough of a risk. If this is the road we're going to go down, which it seems like it is, then there's nowhere near enough of a risk premium in either the dollar or in treasuries to account for that.
No, I agree with that, and I'm going to look at treasuries in a moment to do with that. But yeah, it's a difficult one. I mean, the erosion of trust, we've seen that in the dollar getting sold off. Then we saw a recovery when all these trade deals started ticking over. because the market's saying, okay, yeah, we've had all the tariff palaver, and now deals are getting done. So there's a bit more confidence going back into the US that we can move forward. Growth still expecting to hold up. The hard data, a lot of the hard data still holding up. So yeah, there's no reason to panic. But then you get this, and it's just another stick for the market to go, okay, you're doing all right, and now we've lost confidence again. So we're going to flood out the dollar and the US. But yeah, it's going to be. It's usually the summer. And I talked about it last trade-off that you need to be prepared for quiet markets, but not with the orange one in play. It's going to be volatile all the way through the summer, I think.
Yeah, I fear you might have jinxed that one, so thank you, mate. But why don't we get on to the dollar and to treasuries, because there's plenty going on there as well.
Yeah, exactly. And it was a bonkers week for the dollar, culminating in that NFP craziness. And it's for me, it's a bit of a positive coming back to markets with fresh eyes. I can almost have a sort of a clearer, broader view of things than being in the noise last week. So for all the volatility, the first thing I checked was what US yields were doing. And that's what I'm going to focus on in this topic, and particularly US 2s and US 10s. Firstly, the 2-year yields, obviously yields have dropped as rate expectations have ramped up. But even so, these yields are still, for the moment, holding up pretty well, fairly well. Now, these yields, 2-year yields, are probably a fair reflection of rates over the short-term, medium-term horizon. And currently at near 3.7%, 3.68%. That's just over 60 basis points lower than the current Fed interest rate midpoint. So it's not screaming that the Fed are going to be rushing through cuts at a hefty clip. But I can certainly see some more room for these yields dropping further if the market, particularly at the start of this week, gets uber dovish on the Fed. But I'll be watching the 350, 360 area for a bit of a stretch point this week. If we're breaking under there, then the market is probably getting too dovish, and the dollar obviously will follow. Now, next is I want to look at the US 10-year yields. The yield here is sitting right at the bottom of the recent range, and we're actually testing it as we're recording this. I've mentioned this range more than a few times on the show. This 420 level is yet another marker for whether the market is really going to push dovish pricing. A few weeks ago, I said we need to watch moves up to the 450 top, and now we need to watch it on the other side. So if 10s hold this 420 level, which is around 112, 10-ish in T-note price, that will likely put the brakes on any further dollar selling. But I feel this is one of those pendulum moments when the market was, one side of things after the FOMC and less dovish, and now we'll swing the other way into maybe going uber dovish. And if it goes too far, I'll be looking to take advantage of that with maybe some counter trades, and yields might be the place to do it.
Yeah, I think you're probably right. And I think there's a fair few moving parts in what we saw towards the back end of last week. While you were sat in a pub swinging light ale somewhere, we had obviously the FOMC, which Powell kind of opened the door to at least thinking about September being a live meeting, but there was certainly nothing explicit around, the timing of a rate cut or anything like that. And then everyone's kind of settling into this summer mode, as you alluded to earlier, just starting to buy back into the dollar just a little bit, and then bang, we get this dismal jobs report, which basically flips the macro narrative on its head entirely, because as we said, with those revisions, have things been weaker for longer than we expected? If that is the case, then is that going to have a knock-on impact in terms of things like consumer spending and stuff like that? So yeah, a fair few moving parts. I do think some of the levels that we're seeing in the treasury market are interesting. This 4.2% in the 10 year is going to be absolutely pivotal. If we close below that today, then I think that is very, very notable indeed. You can probably count on one hand the number of times we've closed below that level in the last 3 months. I do feel, though, as if we have gone to a bit of an extreme in terms of where the market is viewing Fed policy expectations. I was looking earlier on, and I think we got about 61, 62 basis points of cuts in the curve by December, which is effectively the market saying 2 cuts plus about an even chance or a coin flip of another 25 basis point cut. Now, with just 3 meetings left this year, that implies either they're going to do what they did last year and go 50 in September, which I think is a push given where the inflation side of things sits, or they're going to go 25 at each of the meetings that they've got this year, which again, I think is probably a bit of a push given where the inflation side of things sits. So really, we're teeing up for a very, very interesting CPI print next Tuesday on the 12th of August, which I think will be very telling, because if that comes in much hotter than expected, then policymakers are in a real bind at that point.
Yeah, between that rock and a hard place. But yeah, I make you right. And, despite the mess of that NFP, it makes the next one really super important, because if it doesn't bounce back, then, as you say, it's pretty much shown that the last 4 months of job numbers have been pretty flat. And then the market's going to go, well, here you go, the Fed again, they're behind the curve. They should have seen this coming, and they should have been getting cuts in ahead of potential weakness. And now it's hitting them in the face like a shovel. So, yeah, and those rate expectations can get more extremely dovish if that happens with the next report.
Yeah, very much so. So, yeah, we're gearing up for another non-farm payrolls number that will be the most important payrolls number the world has ever seen, until we get the next one, which is even more important.
And you might get close on this one. You'll note I was 4K out with my guess compared to your, I don't know, you were miles away.
Well, I was in at 125, but we won't talk about
that. Moving on.
Yeah, very swiftly on. Bank of England, they meet on Thursday, and well, here we go again, because it's another Monetary Policy Committee meeting where 3 or 4 weeks ago you just sat here and gone, the BOE, they're going to turn dovish. They're going to finally start to focus a little bit more on the labour market, provide a little bit of support to the ailing growth backdrop here in the UK. In those 3 or 4 weeks, data has moved in the complete opposite direction to that which the MPC had hoped, with inflation now running at roughly 18-month highs here in the UK. And as a result of that, we have the committee again probably massively split, not only on where rates should sit, but also in which direction rates should be moving, which is easy for me to say. A 25 basis point cut is pretty much nailed on to 4%, and that would be the third such rate cut this year, and it would also be the fifth rate cut of the cycle. And along with that, given the relatively high inflation that we're still dealing with here in the UK, and also the relatively intense underlying price pressures, they'll probably reiterate their gradual and careful guidance in terms of the future pace of rate cuts, and also note again that policy needs to remain restrictive for sufficiently long in order to reduce the risk of price pressures becoming persistent. Really, the interest around the MPC on Thursday comes in the form of the vote split. Now, you think back to the June meeting, there were when bank rate was held steady, of course, there were 3 dissenters in favour of a 25 basis point rate cut. They were external member Taylor, external member Dingra, and Deputy Governor Dave Ramsden. This time around, I think it's going to be a much greater number of policymakers in favour of that 25 basis point cut. But I would imagine that Dingra, being the uber dove that she is, would probably dissent in favour of a larger 50 basis point move. But I think it's unlikely she would be joined by any others. And then at the same time, you've got the, well, if I'm being polite, wild card vote of external member Catherine Mann, who was last year a hawk, started the year as a hawk, then became a dove, then became a hawk again. I would imagine she is probably going to vote for rates to remain steady this time out, given that she has noted the challenges around high inflation in recent weeks. So potentially a 3-way split on the MPC once more. The bank will also give us their latest economic forecast, which, given what we've seen in terms of the outturn recently, higher inflation, slower growth, higher unemployment rate, finger in the air stuff, as you allude to. The question is, are the effects of those going to be prolonged? The bank currently see, for example, unemployment peaking at 5% next year, and they see inflation back at the 2% target in the first part of 2027. Do they raise that peak unemployment projection? Do they push out when inflation may be getting back to target? I think they're the 2 things to watch in terms of the forecasts. I'm debating whether this will have any impact on the pound whatsoever, to be completely honest with you. I think if we get a sort of status quo statement, the vote split is very much just noise. The market's already discounting another cut by year end. OAS prices that for December. It will probably be November, but that's not really a big deal. I think, frankly, I'm struggling to see this being a massive game changer in terms of where the quid is heading next. And it's worth mentioning that we did last week notch, despite all of that dollar weakness on Friday, a 4th straight weekly decline in cable.
Yeah, well, here we go. Rock and a hard place. Always
Yeah.
evident in the Bank of England, and I'm going to have that tattooed on my grave, I think. But yeah, if they cut, we spoke about this months ago. They could have cut June, or May, June, July, whenever, and it wouldn't have made much difference. But it would have kept rates restrictive while giving a little bit of a easing or less restrictiveness to the economy. I think they're in the same position now. They can cut 25, still keep rates at 4% to try and combat inflation, but at least give maybe mortgage holders a little bit of a boost, and while mugging off savers, of course. But it's not going to make a blind bit of difference either way. I still think price pressures are going to remain in play. Been speaking about all these this next round of public sector pay rises, the doctor strike, which is going to end in no doubt in higher pay, and then we'll get everyone else jumping on the bandwagon looking to do the same. So as always with the UK, inflation's really going to be more sticky here than it might be elsewhere. If it's temporary in the US, it's probably going to be even longer temporary in the UK by a few months. And that's what they've got to decide what to do. The vote is going to be interesting. I've got a suspicion if they do cut, then it's going to be a heavily voted for cut, maybe a 7-2 or something like that. And then those that voted for cut are going to switch back into pause mode straight after, the likes of Mann, perhaps, and so on. But yeah, really, it's going to be about what they see for the future. Is this going to be the start of a cutting phase, or are they going to insinuate that this is going to be a cut and then another pause and wait and see moment? And then we'll come away from it thinking, well, why did you bother? You could have cut months ago and done another little one today. But again, you're going to be behind the curve when you should be perhaps getting ready to move. For the pound, the only thing I can see on the quid is if they do indicate that this might be the start of a new phase of cutting. And for pairs like euro sterling, or if you're looking at potential rate divergence trades, it closes the gap a bit more over Europe and some of the others. But with rates still up at 4%, they don't want them up here, so they're going to be coming down at some point.
They are, just probably not as slowly, not as rapidly, or as much as the mortgage holders that you alluded to, or the government would like. And you're going to cheer us all up by talking about the government now, aren't you?
Yeah.
I'm off to go and get myself a stiff drink, I think.
Yeah, you were looking forward to this one, weren't you?
Oh, mate, my favourite subject, honestly. It's almost a challenge to myself now. Can I get through the next 5 minutes without saying a word I'm not allowed to say on television?
What, Reeves?
Well, not that.
I know exactly what you mean. We need to X-rate this show if you want to be doing that, and then we'll need age verification, I'm sure. But yeah, the news out of the UK hasn't improved since last week and me being off. To give a couple of examples, in the first quarter this year, a record 5 billion was taken out of pension funds following Reeves's budget announcement that pensions would fall under inheritance tax. Now that money is either going to be kept in cash under the sofa, spent, or given away to relatives. Now, if it's spent, that will be good for the economy, of course, but then we've had the council tax news out now, and it seems like a good chunk of people will be seeing their bills going up by £400 to £500 over the next couple of years. So it's likely a good chunk of that pension spending will go towards those types of increases, and we're going to be getting others like that along the line as well. Then we have the situation where she decided to add VAT to private school fees, which was expected to raise 1.7 billion, which has now been marked much lower, so she's not going to be earning from that. And in a bit of a double whammy since that announcement, some 50 private schools have closed, meaning there's around 11,000 children, nearly 4 times the number that Reeves's Treasury Department forecast to leave private schools, and they've all moved into public schools at a cost of around £88 million per year. So she's lost the income from the VAT raise, and that is costing her more to put these kids into public sector schools. Last week, the Institute Directors' Economic Confidence Survey fell to the lowest since it started and well below the COVID lows. So yet more firms are losing confidence in the Chancellor. And all of this is on top of the national insurance rise that's affecting jobs and businesses. As I mentioned, junior doctors going on strike for more money, which if they get that, everyone else will be jumping on the bandwagon from other sectors. So it looks like we're in a bit of a doom loop, and I see no signs of us pulling out of it at the moment. My Euro Sterling player of the day last week went on a bit of a wild ride while I was off, dropping close to the 86 handle before bouncing all the way back to the 87s. But I'm still happy to be in it and to sit in it for as long as necessary, price permitting, of course. And I'll only rethink it's not working or rethink the trade if we're heading back under the 8,500 level. But by that time, I'll likely know that something has changed anyway. So we'll probably be looking at the exit door anyway. So for now, I'm still very bearish on the UK over the months ahead, and happy to stay long euro sterling on the back of it.
Yeah, we're in trouble, aren't we?
Yeah.
I don't see how we get out of it. You know, we've spoken about it on the show before. I mean, yeah, what are the options? You can, to meet the fiscal rules, to rebuild the headroom. So Rachel Reeves had 9.9 billion quid's worth of headroom in March. That's all gone. Let's just assume it's gone. We're probably in the hole by a similar amount. So you need 20 yards to rebuild that headroom. What are you going to do? You can't. You can try and raise taxes more, but as you've rightly just proven there, we're at the point where further tax hikes are just frankly futile. They're not raising the revenue that it's thought they would, and that would be the same no matter which tax lever you pull. Spending cuts, you can't get through your own parliament, even though you've got a majority of 160 odd. Your own backbench MPs, if you're Rachel Reeves, aren't going to vote for those spending cuts. So that's a non-starter. You can't increase borrowing because the market simply won't accept it. I know it's a massively consensus view, but short sterling, short the long end of the gilt curve, wait for something to blow up, because it feels like inevitably we are going to get to that crisis point where the doom loop sort of spirals so much that the only way out of it is the market effectively rebelling and those bond vigilantes taking control. Reeves is thrown under the proverbial bus, someone else comes in, and God only knows how they deal with it. But, you know, a fresh set of eyes, maybe they'll have more of an idea than we will. But I'm with you. I just do not see a bull case for the UK economy right now.
Yeah, and I have to say, I'm never a perma bear on the UK. You know, we've always bucked the trend, even when, you know, we've had our backs against the wall. We found a way to, you know, pull away from it and pull out from it, and things have never been as bad as forecast by the press or told by the press. But this time, it's probably one of the only moments where I've been so bearish the UK in all my time in trading. And yeah, it's not looking good. I hope it changes, obviously, because we're living here, so we don't want to be living through that disaster. But yeah, and I get the feeling maybe there's a bit of head in the sand for markets over the stuff that's coming in the future over the next few months, the next budget, November, October. So yeah, I think maybe a crunch point is coming, so we'll keep an eye on that one.
Yeah, absolutely, and I think you're right. The market does feel like participants are either unaware of what could be looming or trying not to think about what could be looming, because the 10-year gilt is sat at kind of 4.6%, the 30-year gilt sat at 5.5%, elevated, but nowhere near the cycle highs, and I would argue in terms of yield, nowhere near as high as it probably should be trading.
Yeah, absolutely. I mean, this is completely different to the trust situation, but the pressure's still there and borrowing costs are still up. So it's all roads point to negativity for the Chancellor at the moment.
Absolutely. Right. On that cheery note, let's get on to our plays of the day. Well, more cheerfulness from me, sadly, because I did end up jinxing that rally in the FTSE last week. Thank you, Mr. Trump, for that one. The index notching its first weekly decline in 6 after I sat here on Monday morning and went, now's the time to go long. So classic Mike Brown market call there. Anyway, as for this week, I'm going to be looking at gold, and hopefully a chart will appear momentarily. There we go. Trump, as we've mentioned many times throughout the show already, appears to be back in his unorthodox ways, let's be polite about it, firing the Commissioner of Stats at the BLS and ramping up his attacks on the Fed yet again. You would imagine that that's going to only re-accelerate those capital outflows from the US dollar, which had taken a little bit of a pause for breath. And what are likely to be the two big beneficiaries from that? Well, it'll probably be the same beneficiaries that have been benefiting from it for most of the year, namely the euro, and secondly, gold. Now, technically, if you look at the gold chart, we held north of the 100-day moving average on that brief run lower last week. That comes in at $3,270 an ounce. And we also managed to close north of the 50-day moving average on Friday among some haven demand after that jobs report. We probably need to break the $3,400 an ounce figure to get the bulls more excited. But if we do, or when we do, then it's really just those June and July highs at $3,440 before we get to a new record high. And I think the developments over the last really 24, 48 hours or so have just cemented that bull case for gold and brought bullion back on to traders' radars a little bit more. Maybe gold's salad days are going to resume relatively soon. Ryan.
Salad days. Where'd you get this stuff from?
Right. Hey, mate, come on. It's a good song. Don't worry, I'm not going to sing, but.
Yeah, well, I hope not, as I'll definitely resign twice. Yeah, I'm talking about dollar MEX this week. Yeah, funny you mentioned your FTSE thing. My euro sterling, I ended up buying at the 87 level after the dip off the high, and then it collapsed all the way to 86 before bouncing back. So we both had a bit of a wobbler last week. But anyway, this week, yeah, dollar MEX, it hit my massive level down at 1850, a big, huge level. If you pop it up on your chart and look back a few years, you'll see how significant that level is. So we hit that. It's put in a half decent bounce, but I'm not certain the bearish trend has turned just yet. A huge confirmation of a bottom would be if we see a dip from here down to test the 1855.60 area. And if it holds there, that could then give it a springboard for a move up through the 19 figure. For the record, I'm still short a little bit from the 21 figure, but I've also been building a separate long into this 1850 level, which I've already been trimming in the 1880s. I would be looking to add back to those longs if I saw that test and hold of the 1855.60 level. On the flip side, a different bullish signal would be if we break and hold above the 19 figure. The danger here still is for longs is a break of that 1850 level. But while that's holding, and if we're holding just above, then I can see some further upside.
Good stuff. I see Pablo Picasso has had a little go at your chart there, mate, with a little white scribble on there. Not sure what's been going on with that one. Right. Anyway, that brings us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Nice of him to actually turn up this week and not be on holiday. Speaking of holidays, thanks to
I was here last week. What are you on about? I was here last week.
You weren't at the desk, mate. When it all kicked off, you were, you had your feet up somewhere while we were slaving away late into the day, Yeah, exactly. Thank you, Kyriakos. You can edit that out for bringing this together as well, as always. Hopefully you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know how you're trading the markets, what you're thinking of everything that's going on. And we'll be back with another episode of Trade Off this time next week. In the meantime, have a very good week ahead. Thanks for watching. Goodbye.